Collecting rent on stock you already own. Today, I'm going to show you how to collect rent on stock that you already own. If you have 100 shares of stock, why not collect a little bit of rent? It's called an option. There's a strategy out there. It's actually called a covered call strategy. If you own stock that's just sitting there, maybe not moving much over the last year or two, why not sell calls on it and collect a little bit of premium? Or you can go out and just buy the stock, buy 100 shares of stock and sell a covered call against it. You can do that too. But if this is something you already own, why not sell these options and make a little bit of extra money? So today I'm going to give you an example of using JP Morgan as that example. And we'll walk through the nuances, some payoff strategies, as well as profit and loss diagrams and that sort of thing. So why would you want to do it? Well, simply put, you've got a portfolio that you want to enhance the return on. That's one. You want to generate a consistent income. And then over time, you can actually reduce your cost basis. So let's say you are doing one of these things and you decide to sell a covered call against it every single month. Well, if that stock doesn't move, let's say it's JP Morgan, and it's, selling for around $270, and you decide that you want to do this every month. Well, as long as the stock doesn't move, then you could sell a covered call against it, say a couple of strikes out of the money. I'll go through that example here in a second. And it might be selling for $3, $4, $5, multiply that by 100. So $300 to $400, $500 per month per 100 shares that you own. And you can do this consistently over and over and over. Every 30 days, generate another $400 or $500, $600 a month. So, and you can do that on, not a really big account. So the way it works is, let's say, I want to walk through this diagram here. Let's say this is the original stock price. Okay. You buy it here. It says sell it for $270 like it is today. If you do not sell a covered call against it, the blue line represents just basically a long diagram, just holding the shares. I mean, if you buy it here and the stock price goes down, well, there's your loss. If the stock price goes up, there's your profit. Well, the way a covered call strategy works, selling these options, is this is the diagram right here. So see this blue line right here? This line right there. Okay. So what that's saying is that we still buy it in this range, but when you have a covered call, it sort of caps your profit right there. So it's only going to go, your profit on the stock is only going to go up to the strike price. So in the example I'm going to show, we use a $285 strike price. Well, if we buy it for $270 and it goes up to $285, well, you keep all that profit on the stock, but you also get the profit on the option, which is selling for, $3.50 or $350. You do that. And then a month later, do it again. You do it again. So you're collecting this rent, so to speak, on stock that you own. That's kind of how the payoff works. Now, there's some risk to it. The risk is you own the stock, and so it could still fall. We'll go through those nuances here in a second. All right. So you only want to do this on stock that are stable, don't move a lot. It can move. Every stock's going to move. But you really want to avoid those high volatility meme stocks, the AMCs, the GameStops of the world. If you were going to buy one of those, the whole idea is speculation. And so you're hoping that thing goes to the moon. If you sell a call on something like that, which you can do, the problem is if it does really go to the moon, you're capping that profit because that call is going to, you're telling someone, hey, I'm willing to sell it at this price. And you have to keep that contract. An option is a contract with another buyer or seller. And so you've got to honor that contract. And if it goes up, it's going to get called away. There's ways to get around that. You could close the call. There's strategies on that. So you're not 100% obligated, but let's say you keep it all the way to expiration, keep things simple. It will get called away if it's above its strike price. ETFs are a great candidate for selling calls. ETFs like SPY, which represents the market, all 500 stocks, 503. QQQ, which is NASDAQ. IWM, if you want to do small caps. So these are ETFs that represent a pool of stock, and a covered call strategy really makes sense for that. But if you have stock that are stable, the JP Morgan's, Bank of America's, maybe some energy, there's even sector ETFs that you can do. Those make great candidates for selling calls against because they're not going to have explosive moves like a stock will. Another thing to avoid is stocks that may have earnings in the next, couple of days. You might get better premium, but if you have news coming out, let's say, in 20 to 30 days and you're selling a call around then, well, there could be a lot of movement in that stock, which could cause it to pass that call strike price, which would cause it to get called away. So now if you hold a stock and you like the stock, it's JP Morgan, solid blue chip, and you don't expect a lot of movement, you can hold that call through earnings. If it gets called away, so what? You can turn around and do another strategy to enter back into it, get paid to buy the stock back. That works well, but if you have some tax liabilities or some tax implications that you don't want to go through, maybe it's worth closing the option before your stock gets called away. But that's a tax thing, and that's beyond the scope of this video. So there's some things that you want to look at: expiration date, picking expirations dates that are, say, 20, 25 days beyond, up to about the 45 to 60 day mark. Don't want to go out too far beyond that because there could be a lot of movement. You want to take the ability of time decay. Every option, create another video, has time decay on that. So you want to take advantage of that. And that sweet spot's really around the 30-day mark. Time decay will happen very quickly. $3.50 I was talking about, that will decay very quickly as the stock maybe does not move and time passes. So expiration date's important when you're picking a covered call strategy. Strike price is also important because you don't want to be too close to the stock price because there's a greater chance of it getting called away, especially if you don't want it called away. I like to pick that stock price, the option price at about 30 delta. And that gives you some room for your stock to go up. So some capital appreciation, but it also gives you the ability to, have a higher chance of keeping that premium. So out of the money, you'll hear these terms, out of the money is just how far out you go on that stock price. And at the money would be, let's say it's selling for 270 and at the money is selling a 270 strike. It's just right where the stock price is currently selling. That's considered at the money. It's got a much greater odds of getting called away. 50 shot. So there's a strategy behind that too, but for covered call, you want to go out a few strikes where your delta is around 30. And then the other option is component is delta, which we talked about a second ago. So let me jump into JP Morgan. Now on the screen, I'm going to show you, I like Thinkorswim. It's an easy platform to use once you kind of get the hang of it. But this is an option chain that we're looking at. Over here is your stock chart, that's your typical view. There's your option chain. Every platform, Interactive Brokers. There's a lot of platforms. I won't name them all, but there's a lot of platforms. They all have some version of this. This is your option chain. And what you're looking at here are all the different strikes. So if you take a look at, this right here. All right, my mouse to work. There it is. Okay. So see this strike price right here, this 270, that is an at the money. As the higher up you go, well, actually in this case, the lower you go, the higher up on the screen, but the lower you go, those are your in the money for calls. These are your out of the money for calls. If you're looking at puts, which is another strategy, this is your in the money for puts. and you're out of the money per put. So your in the money is shaded in blue, out of the money is in black. So for this example, let's say we want to do a 285 strike. Here's the delta I was talking about. That's 29. That's 0.29. Just multiply by 100 because an option is for a contract of 100 shares. Multiply that by 100. So there's your 30 delta, your 38 delta, and your 48 delta. And the further in the money you go, these are your different deltas. And that's basically your probability of assignment or probability of where the stock's going to be at expiration. So this is for expiration 29 days out, July 18th, 29 days out. At 285, there's a 30% chance that it will expire above this price. Said another way, there's a 70% chance of keeping profit. I like those odds, 70%, 70 to 80%. It makes a lot of sense to me. Probabilities in my favor. And that's taking all the market participants and what their view of the market. There is modern portfolio theory shows there's no, would say that there's no hidden data out there. So there's all the market participants' beliefs. This is where it's expected to be in the next 30 days. Well, 30% chance of being here in the next 30 days. So you're playing probabilities. Okay, so with that, I'm going to click on this. I'm going to sell this because I already own it. And there it is, $3.50. Now it says for 10 contracts, let's just do one for simplification. And there it is, $350 minus trading costs. Okay, I'm going to step out of this view real quick because this is for a single call. I'm going to change this to a covered call. I like to do custom because I like to know what's going on. It's just easier. There's your covered stock. So you don't get the same view as far as the in the money, out of the money, but we're going to go up to that 285 because the price is already reflecting the option price in it. So if you go here, 285. So right now it's 273. There's the stock price, 273. And if I take that 285 and I just buy that, it's already reflecting the option price in it. And there's the profit diagram. That is what it looks like. That's what we saw on the other screen. All right. So I'm going to go back to single because it just makes more sense. I'm going to take that stock price. Let's say I'll buy it at the 273.96. So I'm going to subtract $3.50. So my real cost basis is 270 because I get to keep that premium no matter what, unless I close it. But I'm going to keep that premium. So that is kind of the setup of how you would execute that order using JP Morgan. Couple of things on the follow-up. I want to go through this diagram here. So let's say we buy it at 269.52. This was using yesterday's closing price. Here are the scenarios that can happen. One, the stock goes down to 260 at expiration. So in 29 days, stock's sitting at 260. Well, you're going to keep the premium. See where it says it expires worthless? So that's $3.50 or $350 that we get to keep. If this is the strike price, the stock price in 30 days, we still get to keep that premium. We get to keep that premium no matter what. At 285, we get to keep the premium at 350 because it still expires worthless. Meaning the option contract, I'm not obligated to sell it because it's below 285. If it's above 285, then I'm obligated to sell it. But because I collected 250, look at this, or 350, if the stock is 290, my option at the day of expiration, I got 350, has lost $1.50. That's essentially taking 290 minus the 285. That's the $5. That's the difference. But I got to subtract what I got paid for. It's 350. So really my loss on the option is only $1.50 or 150 bucks. But the stock price was able to grow from 269 to 290, giving me $20.48 profit per share. So that's $2,000 profit minus the 150 gives me 1898 in total profit. But the odds of it going to 290, we saw on the other screen, the odds of it going to 285 was 30%. Odds of it going to 290 is probably around 15%. So the odds of it going up here, hey, if it goes up there, great. No harm, no foul. I get to keep the 350 bucks. I also get to make all that capital appreciation. But no matter what happens above 290 or 285, actually, I'll call it 288.50. The profit is exactly the same anywhere above 288.50, no matter what. That is the strategy, is it caps it, but the odds of that happening are, we said about 10, 15%. So let's say 85% chance of it not happening, which means I get to keep that 350 and I get to do it again. This is your sort of your profit loss diagram in table form. If we were to buy it for 269.52 and we sold that call for 350, well, look, it brings my cost basis down to 266. So no matter what, my cost basis now is 266. If I sell just the one option, that's okay. If I get it again, I'm going to collect that premium at a lower that cost basis. So in theory, you could work it all the way down to zero, but that would, of course, you could see that would take a long time. All right. So those are the different scenarios that could happen. The downside risk, let's say, well, a couple of risks. I won't say it's a downside risk. The opportunity cost. If the thing goes through the roof, you're going to miss out. Again, 15% chance of that happening. The downside risk is, well, falls below the 266 mark, you're going to lose because the stock is still, dropping, but it's definitely better than just buying the stock and holding it outright. I would much rather own the stock, sell a call against it, drop my cost basis every single month. I can't. There's some other advanced strategies like rolling the option. That is, let's say you're close to expiration and maybe you're a little bit of a loss on that option, but you've gained on the capital on your stock price. You may decide to roll it if you don't want it to get called away. It's more of an advanced strategy, probably for a different video. So the way this works over time is, stocks do this. They go up and they go down, they go up and they go down. So let's say we buy the stock here, 269. And we sell a covered call. This is that 285 mark. Whoops, that's a little crooked. Doesn't really look like that. Actually, I'll redo that again. I like it. Reference. And let's say it expires here. As long as the stock stays below that, we keep that premium. If the stock goes above that, it's going to get called away. Now, let's say it stays below that in our ideal situation. And it's, trading in this spot. This is June of 25. July. August. Well, if JP Morgan is somewhere around that 280 mark, I'm going to go another 30 delta. I might sell it at 295. And that will be selling for, let's say, 350 here, 350 there. And let's say that stock moves up and down and it's roughly there and it's 290. Well, I can do that again, sell another call premium, another option for $3.50. I could do this every single month. The challenge becomes if the stock, say, takes a nosedive And now we're in September. And let's say the stock's selling for $2 or $240. Well, I've gotten 350 times 3. Okay, so I've got $10.50. I bought it for 269, dropped it by $10.50 because of my call premiums over the next 3 months, in theory. So my cost basis is now around 268. I'm sorry, 258. But if my stock took a nosedive at 240, you may not want to sell a call here, because if you sell a call here at 30 Delta, it might only be at that $250 strike. In that case, you'd be taking a loss if the stock were to reverse and go back up. So in that case, you'd want to just sit and hold your stock, wait for it to reverse, and then continue selling options once your price of the stock is above your cost basis. And that's pretty much it. That is a covered call strategy. So I hope that makes sense. Be doing more of these videos. Click the subscribe button and we'll see you next time. Thanks.